Ever wonder why most investors don't follow the rules they learn? In this video, we're diving into investing rules for real life, where behavior trumps theory. You'll discover practical tips that can help you navigate the market with confidence. What if I told you that a simple change in mindset could lead to better financial outcomes? Let's explore how. Have you ever found yourself lost in the sea of investment theories, wondering which ones actually apply to your everyday life? Picture this. You're at a coffee shop, sipping your favorite brew, and someone mentions a complex investment strategy that sounds like it belongs in a finance textbook. But what if I told you that the real secret to investing isn't in the theories, but in the simple rules that guide your behavior? Today, we're diving into investing rules for real life that prioritize your actions over abstract concepts. We'll explore how small, consistent decisions can lead to big results, and how understanding your own behavior can be your greatest asset. So, are you ready to transform your approach to investing? If you find this topic intriguing, don't forget to like this video, share it with your friends, and subscribe to Chill Finance for Real Life for more insights that can help you navigate your financial journey. Before we dive in, a quick reminder, this video is for educational purposes only. It's not financial, legal, or tax advice. Always do your own research and consider seeking professional guidance if you need it. Remember, your financial journey is unique, and it's important to make informed decisions. Alright, let's get into the rules for investing in real life. Imagine you're at a buffet. There's a spread of delicious food, but you know you can't pile your plate too high. If you do, you might end up with a mess or even waste some of that tasty food. Investing is a lot like that buffet. You want to make smart choices that fill you up without overwhelming you. In today's video, we're diving into real-life investing rules that prioritize behavior over theory. What? Because investing isn't just about the numbers, it's about how you act with those numbers. Let's start with a fundamental truth. The market, on average, has historically returned about 7% per year. This number isn't just a random pick. 7% is a realistic expectation that accounts for growth over time while factoring in inflation. Think of it as a steady pace in a long marathon, not a sprint. Now, let's talk about one of the biggest rules: consistency. Just like brushing your teeth every day keeps your smile bright, regularly investing, even small amounts, can lead to significant growth over time. If you invest just $100 each month at that 7% return, after 30 years, you could see that grow to over $250,000. That's a nice chunk of change, all from a commitment to consistency. But here's the kicker: life happens. Maybe you lose your job or have unexpected expenses. It's easy to think, I'll just stop investing for a while. But remember, in our buffet analogy, if you skip the food today, you might miss out on the nourishment you need for tomorrow. Instead of stopping completely, try adjusting your contributions. If you can't invest $100, maybe it's $50. The key is to keep going, even if it's at a smaller scale. Let's also consider the importance of patience. Investing is not a get-rich-quick scheme. It's more like planting a tree. You water it, nurture it, and wait. Over time, it grows, and eventually, it bears fruit. If you pull it up too soon to check the roots, you might damage it. So, when the market dips, and it will, don't panic. Instead, remind yourself that those dips are part of the natural cycle. Here's a quick story. A friend of mine started investing in his 20s. He wasn't making a lot of money, but he set aside a little bit every month. Fast forward to his 40s, and he's now sitting on a comfortable nest egg. He always says, "I didn't do anything special, I just showed up every month." That's the power of patience and consistency. Now, let's pivot to another key rule: education. Understanding what you're investing in is crucial. You wouldn't buy a car without knowing how it works, right? The same goes for investments. Take the time to read, listen, and learn. Knowledge is your best friend in the investing world. And speaking of friends, let's chat about community. Surround yourself with people who share your financial goals. Whether it's a group of friends or an online community, having support can keep you motivated. It's like having a workout buddy. You're more likely to stick to your routine when someone else is in it with you. As we wrap up, I want you to think about this. What's one small step you can take today towards your investing journey? Maybe it's setting up an automatic transfer to your investment account or reading a book about personal finance. Remember, it's all about behavior over theory. So, next time you think about investing, picture that buffet. Choose wisely, be consistent, and don't forget to enjoy the journey. What's on your plate today? Let me know in the comments below. Imagine you've just received a bonus of $1,000. You have two choices: spend it all on a new gadget or invest it. Let's explore what happens when you choose to invest that money instead. We're going to use a consistent interest rate of 7%. This rate is a reasonable estimate based on historical stock market returns over the long term, adjusted for inflation. 7% gives us a solid foundation for our calculations. So, if you invest that $1,000 today, how much will it grow in 10 years? We can use a simple formula for compound interest, which is the money you earn on your initial investment plus the money you earn on the interest that has already been added. The formula is future value equals present value multiplied by 1 plus the interest rate raised to the power of the number of years. Let's break this down step by step. First, we start with our present value, which is $1,000. Next, we add 1 to our interest rate. 7% in decimal form is 0.07. So, 1 plus 0.07 equals 1.07. Now, we raise that to the power of 10, since we're looking at a 10-year investment. 1.07 to the power of 10 is approximately 2.007. Now we multiply that by our present value. $1,000 multiplied by 2.007 gives us $2,007. So, if you invest $1,000 at 7% for 10 years, you'll have about $2,007 at the end. That's a profit of $1,007 just for letting your money work for you. Now, let's say you keep this investment going for another 10 years, making it a total of 20 years. We'll use the same process. We already know that $1,000 grows to $2,007 in 10 years. Now, we take that future value of $2,007 and repeat our calculations. First, we add 1 to the interest rate again, 1.07. Then, we raise it to the power of 10 again, which is still 2.007. Now we multiply. $2,007 multiplied by 2.007 equals about $4,021. So, after 20 years, your initial investment would grow to approximately $4,021. That's a total profit of $3,021. Now, here's a little pattern interrupt for you. Think about this. If you had chosen to spend that $1,000 instead, you would have nothing to show for it in 20 years. Investing is about making your money work for you, not just spending it. Let's switch gears for a moment and consider a different scenario. What if you decided to invest that $1,000 every year for 10 years instead of just once? This is often called dollar cost averaging, and it can have a powerful effect on your investment growth. If you invest $1,000 each year for 10 years, each of those investments will grow at different rates depending on how long they're invested. The first one will grow for 10 years, the second for 9 years, and so on, down to the last one, which will grow for just 1 year. To keep it simple, we can calculate the future value of each one separately and then add them up. The first $1,000 grows to $2,007 after 10 years. The second $1,000 grows to $1,081 after 9 years. The third $1,000 grows to $1,056 after 8 years. Continuing this pattern, we find that the fourth year's investment grows to $1,035, the fifth to $1,015, the sixth to $942, the seventh to $923, the eighth to $906, the ninth to $892, and finally, the 10th $1,000 grows to $930 after just 1 year. Now, if we add all these future values together, we get a total of about $6,038 after 10 years. That's a significant difference compared to investing just once. It's clear that the more frequently you invest, the more your money can grow, thanks to the power of compound interest. So, here's a question for you. Are you ready to let your money work for you instead of spending it all? Remember, every little bit counts, and the earlier you start, the more you can benefit from compounding. As we wrap up, think about this. Investing isn't just about the numbers, it's about your choices and behaviors. The rules for real life in investing are simple. Start early, invest regularly, and let time do the heavy lifting. So, what's your next step? Will you choose to invest that bonus or spend it? Let us know in the comments below. And remember, every dollar counts. Imagine a young woman named Sarah, fresh out of college, excited to start her career. She lands a job that pays her around $50,000 a year. Sarah is eager to save, but she often finds herself tempted by the latest trends in fashion and tech. One day, her friend introduces her to the concept of investing. Why not start small? Her friend suggests. Sarah decides to invest $100 a month into a retirement account. She learns that if she invests that amount consistently, with a 7% annual return, she could grow her money significantly over time. After 10 years, that monthly investment could turn into about $15,000. This sparks a realization for Sarah. It's not just about saving, it's about making her money work for her. She becomes more disciplined, setting aside her shopping sprees for her future. Now, let's think about another story. Meet Tom, a 35-year-old father of two. Tom is always busy juggling work and family life. He's heard about investing but feels overwhelmed. One day, he stumbles upon a podcast discussing the importance of starting early. The host emphasizes that behavior matters more than theory. Tom decides to take action. He starts by investing $200 each month into a diversified portfolio. With the same 7% return, after 20 years, Tom could accumulate around $120,000. That's a significant amount for his kids' education, all because he chose to prioritize investing over immediate spending. Now, let's switch gears and talk about Maria, a retiree in her 60s. Maria has always been cautious with her money, preferring to keep it in a savings account. One day, her grandson asks her about her plans for retirement. She realizes she hasn't thought much about growing her savings. After some research, Maria decides to invest a portion of her savings. She starts with $500 a month. With a 7% return, she could see her investment grow to over $100,000 in 15 years. This gives her peace of mind, knowing she can enjoy her retirement without financial stress. What about you? Have you ever thought about how small, consistent investments could change your financial future? Let's look at another example. Here's Jake, a 25-year-old who just landed his first job. He's excited about his salary but is unsure how to manage his finances. He attends a workshop on personal finance, where the speaker emphasizes the power of compound interest. Jake learns that if he invests just $50 a month, with a 7% return, he could have around $25,000 by the time he's 45. That's the beauty of starting young. It's not about how much you invest, but how consistently you do it. Lastly, let's talk about Linda, a busy entrepreneur in her 40s. Linda has been so focused on her business that she hasn't thought about her personal finances. One day, she meets a mentor who encourages her to invest in herself and her future. Linda starts by setting aside $300 a month for investments. With a 7% return, she could accumulate over $50,000 in 10 years. This newfound focus on investing not only helps her personal finances but also inspires her to teach her children about the importance of financial literacy. So, whether you're just starting out, raising a family, or approaching retirement, remember that investing isn't just about numbers. It's about your behavior, your choices, and how they can shape your future. Investing is often seen as a complex game of numbers and theories, but in reality, it's about behavior. One key lesson is to focus on your emotions. When you invest, your feelings can cloud your judgment. Fear and greed can lead to poor decisions, like selling in a panic or buying at a peak. C. Recognize these emotions and take a step back. D. Ask yourself, is this decision based on facts or feelings? Alright, now let's zoom out to the next point. Consistency is crucial. Regularly investing a set amount, like $100 each month, can build wealth over time. B. This strategy is called dollar cost averaging. C. It reduces the impact of market volatility. D. Imagine if you invested during a market dip, you'd buy more shares at a lower price. Another important lesson is to diversify your investments. Don't put all your eggs in one basket. B. Spreading your money across different assets, like stocks, bonds, and real estate, can reduce risk. C. If one investment doesn't perform well, others might. D. Think of it as a safety net for your finances. Next, let's talk about the power of patience. A. Investing is not a get-rich-quick scheme. B. It often takes years to see significant returns. C. For example, if you invest $1,000 today, and it grows at an average rate of 7% annually, it could double in about 10 years. D. So, are you willing to wait for your money to grow? Now, let's consider the importance of setting clear goals. What do you want your investments to achieve? B. Whether it's saving for a home, retirement, or travel, having a clear target can guide your decisions. C. Write down your goals and review them regularly. D. This keeps you focused and motivated. A quick recap here. Investing is about behavior, not just numbers. Remember to manage your emotions, stay consistent, diversify, be patient, and set clear goals. Lastly, always keep learning. The financial world is ever-changing. B. Read books, attend workshops, or follow credible sources. C. Knowledge is power, and staying informed can help you make better decisions. D. What's one new thing you learned today that you can apply to your investing journey? So, as you embark on your investment journey, remember these lessons. They're not just rules, they're tools for real-life success. What will you focus on first? Have you ever felt overwhelmed by all the investing rules out there? You're not alone. Many people think they need to follow every theory to succeed in investing. But here's the truth, behavior often trumps theory. Now, let's address some common objections. First, you might be thinking, but what about all those experts who say you need to diversify your portfolio? Yes, diversification is important, but it's not just about spreading your money around. It's about understanding your own risk tolerance and making choices that fit your life. If you're investing in what you truly believe in, you'll be more likely to stick with it during the tough times. Another common concern is, I don't have enough money to invest. Here's a quick story. A friend of mine started investing with just $50 a month. Over time, those small contributions grew, thanks to the power of compounding. If you start with a small amount and stay consistent, you can build wealth over time. You might also be wondering, what if I make a mistake? Mistakes are a part of the learning process. Instead of fearing them, embrace them. Each error teaches you something valuable about your investing style and preferences. So, what's stopping you from taking that first step? Remember, investing is about your behavior and choices, not just the theories. Now, I want to hear from you. What's your biggest concern about investing? Share it in the comments below. Let's start a conversation. Alright, now let's zoom out and explore how you can apply these principles in your everyday life. Have you ever wondered why some people seem to thrive in investing while others struggle? It often comes down to a few simple rules that prioritize behavior over theory. Today, let's explore some investing rules for real life that can help you navigate your financial journey. First, let's talk about the importance of patience. Investing is not about quick wins, it's a long game. Imagine planting a seed. You water it, give it sunlight, and wait. Over time, it grows. The same goes for your investments. If you expect instant results, you might be disappointed. Next, let's discuss emotions. Have you ever made a decision when you were angry or excited? Investing requires a cool head. When the market fluctuates, It's easy to panic. But remember, staying calm and sticking to your plan is vital. Now, let's dive into diversification. Think of it like a balanced meal. If you only eat one type of food, you might miss out on essential nutrients. Similarly, spreading your investments across different areas can help reduce risk. Alright, now let's zoom out and consider the importance of continuous learning. The financial world is always changing. By staying informed, you can adapt your strategy and make better decisions. Finally, let's recap. Patience, emotional control, diversification, and ongoing education are key. These rules can guide you through the ups and downs of investing. So, what's your biggest challenge when it comes to investing? Share your thoughts in the comments below. And remember, it's not just about what you know, it's about how you apply it in real life. Happy investing. As we wrap up, remember these key investing rules for real life, where behavior truly matters more than theory. Stay patient. Investing is a long game. Diversify your portfolio to spread risk. Keep emotions in check. Avoid impulsive decisions. Regularly review your investments to stay aligned with your goals. Educate yourself continuously. Knowledge empowers better choices. Investing isn't just about numbers. It's about understanding yourself and your goals. So, take a moment to reflect on your own approach. If you found this video helpful, please like, share, and subscribe for more insights. Remember, invest in your future, one step at a time. Until next time, keep your mind calm and your finances chill. And don't miss our next video, where we'll dive into the importance of setting financial goals. It's a journey worth taking.